Hi. On the second page of your notes for hedging interest rate risk for a portfolio, you will see a formula for duration gap. I'm going to bring that up here to be able to share with you so we can make sure we're both looking at the same thing here. And you'll see that the duration gap is equal to the duration of your assets minus the ratio of market value of your liabilities to market value of your assets. That L over A is the market value of your liabilities divided by the market value of your assets, multiplied by the duration of your liabilities. So it's a fairly simple concept. The duration gap is basically the duration of your assets minus the duration of your liabilities, but it's scaled by the market value of liabilities divided by the market value of your assets. So let's suppose our assets and liabilities are equal to each other. Okay, if we've got the same market value of our assets and liabilities, then it will be the duration of your assets minus the duration of your liabilities is the duration gap. If you have more liabilities than you have assets, then we put a heavier weighting on the duration of your liabilities, right? Because the L over A is going to be greater than 1. If you have more assets than liabilities, then L over A will be less than 1, and you put a lower weighting on the duration of your liabilities. So the L over A just allows for a greater weighting on your assets or your liabilities, whichever has the highest market value there. So we're going to go through some examples here, assuming, just because it's simpler this way, assuming that you've got the same market value of your liabilities as you do for your assets, okay? And then we'll be able to make some changes if we want. So what we've got here is if the duration of your assets is greater than the duration of your liabilities, you will have a positive duration gap. If your duration of your assets is less than the duration of your liabilities, you will have a negative duration gap. Now, the whole key here is if you have a positive duration gap, you are going to be affected differently by changes in interest rates than if you have a negative duration gap. So let's take a look at an example here. And to do an example, I'm going to bring up the whiteboard. And we're going to start out by talking about a bank. Now, this is not necessarily representative of all banks, and banks are much more complex than what I'm going to be putting up here, but I think it will help us at least for a little bit. So we're going to take a look at a very simple bank here, okay? And we want to ask the question, what are the bank's assets? And what are the bank's liabilities? Okay, so the liabilities of a bank are going to be its deposits. Remember, liabilities is where you owe some money. Deposits are assets for you. If you deposit money in a bank, that's an asset of yours, right? So it's got to be a liability for a bank. The bank owes that money back to the depositors. So the liabilities are typically going to be your deposits. Okay, there's other things too, but we'll just say it's deposits. Okay, what are the assets of the bank? Typically, it's going to be its loans, because if you borrow money from the bank, that is a liability. You owe the money to the bank. For the bank, that loan is an asset. Okay, so that's going to be the loans that it makes. And it may be mortgages, it may be commercial loans, it may be car loans, whatever it happens to be there. Okay, so a bank has the assets and liabilities. Hopefully you're seeing now that for every financial instrument, fixed income instrument that we're referring to, one side, for one party, it is an asset. For another party, it's a liability. For a deposit, for you as the depositor, it's an asset. For the bank, it's a liability. For a loan, for the bank, it's an asset. For you, it's a liability. Well, let's think in terms of the duration of these two things, the loans and the deposits. For deposits, typically you can get them anytime. Okay, very short period of time that it's tied up. Okay, your checking account, you can get to it anytime. If you have your money in a certificate of deposit, maybe it's tied up for 6 months or 1 year or something like that. Very short-term periods. As a result, deposits have a very, very short duration. Loans, however, are going to be a different matter. Loans typically for a bank, maybe, well, for car loans, it may be 4 or 5 years. For commercial loans, maybe about 8 years. For mortgages, they could be 30 years. But without a doubt, the duration of a loan is greater than the duration of a deposit. So we're going to say that the bank's assets are going to have a high duration and the bank's liabilities are going to have a low duration. Okay. So what we want to think about for this simplified version of a bank is what happens to the bank, to its balance sheets, if interest rates go up, and what happens to the bank if interest rates go down. And we want to think in terms of its duration gap. Okay. Now, first of all, if we make this assumption that the bank has the same market value of its assets as liabilities, okay, the duration gap for the bank is going to be the duration of the assets, we have just said is high, minus the duration of the liabilities, which we just said was low. So therefore, the bank's duration gap is going to be positive. Bank will have a positive duration gap. So with that positive duration gap, what's going to happen if interest rates go up? Well, if interest rates go up, the value of a fixed income instrument goes down, like a bond, okay? We know that already. If interest rates go up, the value of a bond goes down. Now, don't forget that a bond is an asset to whoever owns it and a liability to whoever issued it. So if the value of the bond goes down, if you own the bond, the value of your asset is going down. If you issued the bond, the value of your liability is going down. Okay, it's an asset to whoever owns the bond. It's a liability to whoever issued the bond. The value of the bond, it goes down. So in this case, what we want to think about with the bank, if interest rates go up, the value of their assets goes, if interest rates go up, what happens is the value of their assets goes down, okay? And the value of their liabilities goes down, both because they're fixed income instruments. But the question is, which goes down by the most? Well, the one with the highest duration goes down by the most, right? Because that's what duration measures. It measures how much does something's value change when there's a change in interest rates. So if interest rates go up, the value of the bank's assets go down, the value of its liabilities go down. But we already got done saying is that the value of the assets, that the assets have a much higher duration than the liabilities. So if the assets have a higher duration, the assets will go way down in value, and the liabilities, they just go down by a little bit. Now, if your assets go way down in value and your liabilities go down just a little bit, overall, is that good or is that bad? Well, when your liabilities go down, that's a good thing. If your assets go down, that's bad. Unfortunately, here, the assets are going way down and the liabilities only go down by a little bit. So overall, we're going to say for the bank, that is bad. When interest rates go up, the value of the bank's assets go down by more than the value of its liabilities. So overall, that's bad. It's going to hurt the balance sheet. Now, if interest rates go down, the value of the assets will go up and the value of the liabilities will go up. Fixed income instruments like bonds go up in value when interest rates go down. Again, a bond for one side is an asset, another side is a liability. Now, for this particular bank, we've already said that the assets are going to have a higher duration and the liabilities have a lower duration. So when interest rates go down, the assets are going to go way up in value. The liabilities, they only go up in value by a little bit. Now, if your assets go way up in value and your liabilities only go up by value a little bit, is that overall good or that's bad? Well, that's a good thing. Okay, you like it when your assets go up in value. You don't like it when your liabilities go up in value. So here, the assets are going up by more than the liabilities. So overall, that's a good thing for the bank. So we're going to see now for this bank, which has a positive duration. And I'm not trying to say this is true for every bank, and there's more to it than this, but this just helps us to be able to see this principle. For anyone who has a positive duration gap, they are going to be hurt when interest rates go up, and they're going to be better off if interest rates go down. Okay. Now let's contrast that with a life insurance company. Okay. Now, this life insurance company also has assets and it has liabilities. What are the liabilities of a life insurance company? Well, it's the death claims that they've got to pay out, right? That at some point in time in the future, they're going to have to pay out money to beneficiaries when people die. Well, generally speaking, okay, those are long-term, those liabilities. If the average person with a life insurance policy is, let's say, 30, 35 years old, on average, it's going to be, what, 50, 55 years, something like that, before the death claim has to be paid out. So the liabilities, okay, which are going to be the claims, okay, are going to have a very high duration. They're going to have a high duration. And the assets, what are the assets of a life insurance company? Well, it's the investments that they take on, okay? And those investments, well, it's typically bonds. And we'll talk about later on the fact that life insurance companies like to buy long-term bonds. But generally speaking, in comparison to the liabilities, the duration of their assets is going to be low. Okay. Now they're not really a low duration, but in comparison to the liabilities, because liabilities have a very high duration for life insurance company. So as a result of that, for the life insurance company, if interest rates go up, the value of its assets are going to go down. The value of its liabilities are going to go down. But because the liabilities have a higher duration, the liabilities will go down by more than the assets do. And that is therefore good for the life insurance company. You like it if your assets go down by just a little bit and your liabilities go down by a lot more. Now, if interest rates go down, that means the assets of the life insurance company go up and the liabilities for the life insurance company also go up. But the liabilities go way up because they have a higher duration. The assets only go up by a little bit. And so overall, that is bad for the life insurance company when that happens. So we're seeing that the life insurance company, by the way, has a duration gap that is negative because, remember, duration gap is going to be the duration of the assets minus the duration of your liabilities. The life insurance company has a higher duration for the liabilities than it does for the assets. So the life insurance company is going to have a negative duration gap. So the principle here is any company that has a negative duration gap is going to be hurt when interest rates go down. Any company that has a positive duration gap is going to be hurt when interest rates go up, just in terms of this interest rate risk. So what we want to always look at is when we're talking about interest rate risk, we want to ask the question, what is your duration gap? And in terms of hedging interest rate risk, the way we can hedge it is get that duration gap close to zero. If you have a positive duration gap, we want to reduce it. If you have a negative duration gap, we want to increase it. If we can get it at zero, you've hedged interest rate risk. You have hedged the risk. You've got a neutral interest rate risk that we talked about. You've got a neutral hedge, and you've also been able to immunize in that situation. Basically, the solution, the problems are different for a neutral hedge and immunization, but the solutions are pretty much the same here. So that's what we want to do in this particular situation here, is we want to take a look at how can we get the duration gap closer to zero. Now, in order to be able to understand some things a little bit better, we want to take a look at what's the difference between a fixed rate bond or a fixed rate investment and a variable rate investment. A fixed rate bond, for example, let's suppose we've got a bond that's a 10-year bond. Okay, so we're looking at something like this. Here's time 0, and here is 10 years, and you've got, let's just say semi-annual payments all along the way, coupon payments, right? There's a coupon payment, and there's a face value out there, okay? And we know that if interest rates go up, the value of this bond goes down. And why does the value of the bond go down? It goes down because the coupon payments are staying level. If interest rates go up, that means other new bonds are making higher coupon payments, which this bond doesn't make higher coupon payments. It's locked in for those coupon payments. That's why the value of the bond goes down. If interest rates go down, why does the value of the bond go up? Because new bonds are being issued at lower coupon payments, and this bond is still continuing to give you that high coupon payment. So the fact that you are locked in with whatever this bond is, for better or for worse, if interest rates go up, that's for worse. If interest rates go down, that's for better. The fact that you're locked in is what causes the interest rate risk, is what causes the bond to have a higher duration, okay? Now let's think in terms of a bond or any kind of a fixed income instrument with variable rate payments. So we're going to show the same diagram here, okay? But what's going to happen is at time period 1 here, just prior to this cash flow being paid, this particular bond is going to take a look and see where are interest rates in the economy. If interest rates have gone up, then this coupon payment is going to be higher, kind of like the tips we looked at earlier. If interest rates have gone down, then the coupon payment is going to be lower. So when you have variable interest rate instrument, you're not locked into fixed coupon payments. And when interest rates go up, you get the higher payments there, higher coupon payments. So you don't have that interest rate risk. If interest rates go down, you receive lower coupon payments. That's not good, but again, it's getting rid of that risk that the value of the bond is going to be moving up and down. So for a variable rate instrument, the duration of it is always going to be equal to how long is it until the next coupon payment, which is going to be adjusted based upon interest rates. So if it's 6 months from here to there, okay, from time 0 to time 1, and we're standing right at time 0, the duration, you can think of this bond as being a 0 coupon bond, and its duration is 6 months at that point in time. By the way, I think I might have mentioned this before. If I didn't, for a 0 coupon bond, its duration is always going to be equal to its time to maturity. For example, let's suppose I have a 5-year 0 coupon bond, like a 5-year treasury strip. Here's time 0, here's time 5 years. And you get $100 out there. Remember, it's a 0 coupon bond, so you don't get anything in between. If you're going to place the fulcrum somewhere to balance this, where do you place the fulcrum? Well, it has to be right here at 5 years, doesn't it have to be? Because that's the only cash flow. And if you do the calculations, go back to our spreadsheet where we're calculating duration, anytime you have a 0 coupon instrument, then the duration of that instrument will be exactly equal to its time to maturity. So we can think of this variable rate bond as being a series of 0 coupon bonds where the coupon rate is going to be adjusting each time based upon interest rates. So from time 0 to time 1, if that is 6 months, then that is the duration of our variable rate bond. Even if it's a 10-year bond, because the coupon payments are going to be resetting, okay, to account for changes in interest rates every 6 months. 6 months would be the duration. So variable rate instruments, variable rate instruments will have a low duration. Okay, fixed rate instruments will have a higher duration. So if you are interested in increasing your duration gap, okay, then you are going to want to obtain some fixed rate instruments. If you are interested in decreasing your duration gap, you would be interested in obtaining some variable rate instruments. This is one of the reasons why swaps are so popular as a hedging tool, because you can swap variable rate payments on a loan for fixed rate payments on a loan, or swap fixed rate payments on a loan for variable rate payments on a loan. We'll talk about some of these ways to be able to hedge a little bit later.